What's going on, my fellow wealth creators? Matty guys here. Welcome to another training. Today we're talking about the infinite banking concept and positive arbitrage. Can you earn positive arbitrage using the infinite banking concept? And I want to do this video because I saw a post the other day. I see them pretty frequently enough to be concerned about it, about how you can get this positive arbitrage with the infinite banking concept, where basically you can earn more in the your policy grows by more than your interest loan rate for the policy loan, right? So for example, if I earn 6% in my policy and I'm only paying 5% on my policy loan, well, now I'm getting positive arbitrage. Sounds really good, looks really good on paper. Doesn't usually work that way. It's not why we set these policies up. Now, it's not to say that it can't happen, but where the positive arbitrage really comes in is how we utilize our policies in order to build wealth. And I'm going to show you an example of that here in a second. But the idea of setting up a policy to get and just let it grow and never use it to build wealth to actually create positive arbitrage, I think is a fundamental misunderstanding of how money works and how the infinite banking concept works as well. And one of my concerns about this too is that I see this primarily from advocates of IUL, because IUL can earn significantly outperform whole life policies. That's a whole other video. IUL is terrible for infinite banking, guys. I'll link down to a video, another training I did on exactly why that is. We'll cover it a little bit in the example I'm going to give here in a minute. But I see this a lot with from IUL agents about this positive arbitrage. It's not why we set the policies up, guys. It's not why we implement that's not the infinite banking concept. The infinite banking concept comes into play with regards to how we utilize the policy. And I'm going to show you real numbers and debunk this whole stupid myth about why whole life is terrible for infinite banking. Because if I pay 5.5% on my policy loan rate, which is currently what I have, my policy grows by about 4% tax-free compound growth. You hear those numbers, and you're like, well, you're earning 4%, but you're paying 5.5% on your policy loan rate. That sounds really stupid, doesn't it? It's a fundamental misunderstanding of the difference between compound and simple interest. And I'm going to show you real numbers. We're going to go through some examples here, and you're going to see why none of that matters. How we use the policy is what really matters when it comes to the infinite banking concept. So we're going to have some fun today. Real quick, though, before we jump into it, quick word from our sponsor. It's actually me. It's my other company, Reduce My FICA. We help business owners significantly reduce their annual payroll taxes. I'm talking $300 to $500 per year per W-2 employee that you could add back to your bottom line. And if you think about the current state of the economy, where inflation's at, we need to be doing everything that we can to reduce expenses, obviously increase income as well. But we use these health and wellness plans to significantly reduce payroll taxes for the business owner, while also providing amazing health and wellness benefits to your employees. So it's really good for employee recruitment and retention. So if that's something that you'd like to learn about, if you're a business owner with at least 10 full-time W-2 employees, I'll have a link down below. It's reducemyficanow.com for more information. All right, let's have some fun on the whiteboard. So the idea of positive arbitrage. All right, so we're going to earn 6% over here in our policy, and we're going to pay 5% on the loan. Okay, this is not what we are trying to do. Not saying this can't happen, all right, but this is not the idea of the infinite banking concept. What we're doing with infinite banking, there's a few different ways that I think about it. Number one is we're putting our money, our capital, into a much more efficient savings vehicle. That's how I think about it, versus keeping the money in the bank where it doesn't really do anything. All right, does the bank give us 3 to 5% tax-free compound growth for the life of the policy? Does it allow us to use the money without interrupting that compound process to go build wealth like we normally would? Does the money in our bank account blossom into a massive income tax-free death benefit if we were to pass away? Right? Things like that, right? So it's a much more efficient savings vehicle, and the liquidity aspect of it is what allows us to really implement the infinite banking concept, become our own bank, finance our large capital purchases to eliminate that lost opportunity cost, and potentially create positive arbitrage within the wealth building opportunity that we're using the policy for. So let me give you an example. This is a real example. I'm going to do a separate video on the actual numbers of this. But I just wired the funds today on my first private money deal. So I'm basically becoming the bank here, where I've put my my safe money, opportunity money, et cetera, into my policies. I'm now borrowing against my policies. My policy loan rate is 5.5%. Okay. I'm now going to lend that out at 12%. I'll just do private money loan. All right, plus points. Actually, in this in my first deal here, I didn't do points. I'll explain that in the other video. But just looking at these numbers right here, I mean, this is pretty simple. This is where the positive arbitrage takes place. And all the while, because I'm not using my own money here, I'm borrowing the life insurance company's money and using my policy as collateral. My money is still continuing to grow inside of my policy. It's continuing to get, mine is set up for about, it's roughly like 4% over the life of the policy. A 4% tax-free compound growth. That's a pretty good savings vehicle, guys, while I'm still taking advantage of different real estate opportunities here, okay? So this is where the positive arbitrage is. This is exactly what the banks do every single day. When they pay us 1% over here, all right, so they give us 1%. So here we are, my terrible stick figure, whatever. All right, they give us 1%, all right, and then they lend it out to this person over here, okay, at 5%, and they keep the spread. That's a 4-point spread. That's a 400% rate of return, whatever, after expenses. Again, I did an entire video on that. But how is this any different? Okay, it's not 400%. It's like 118% right here. But I would say that's pretty good. That's not a bad deal. I'm doing literally exactly what the banks do, taking advantage of positive arbitrage here. Arbitrage being the difference between these two interest rates here, right? So I'm paying 5, just like the bank would pay me 1% to keep my money in the bank, but I'm lending it out. I'm earning 12%, just like they're earning 5%. So their spread's a little bit better than mine. But this actually gets better and better and better every single year as my policy gets more efficient. I'll talk about that in the other video. But guys, what I want to stress here is this is not, right over here, this is not the positive arbitrage that we're trying to get with the infinite banking concept. This is what, if you're trying to get positive arbitrage, it's how you use the policy. It is not, oh, I'm going to earn 5 or 6% of my policy and only pay 4 or 5%, whatever, right? And, you know, like I said before, I see a lot of this come from people that sell IUL. I want you guys to be really, really careful with that. Please watch the training I did on why you absolutely do not want to use IUL for infinite banking. All right, I'll have that down in the description. But to hit the point home, this is where the positive arbitrage comes in, is how we use our policy. Now, the other pushback that I want to address and the principles that I want to just clarify, I guess, is the difference between simple and compound interest and the impact it has on money. Because some of the pushback I get on this too, that I hear oftentimes against dividend paying whole life insurance for infinite banking is because, oh, like if my policy loan rate, so yeah, I mean, this is a real example. My policy loan rate is 5.5%, but I'm only earning 4% in my policy, right? So I'm earning, paying. Okay. So a lot of people will look at that and say, well, you're an idiot. Why are you doing that? That doesn't make any sense. That's why whole life is terrible for this, blah, 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 blah. All right. Very, very, very fundamental misunderstanding of how money works and the difference between simple and compound interest. I've run this example multiple times, but I'm just going to go through it again here really quick. All right. Just to show you how you could actually pay double the interest rate on your policy loan than what you're earning in the policy and still come out ahead in the long run. Okay. Watch this, guys. I've done this example before. So what I typically use when I'm showing the difference between simple and compound interest is when I purchased my vehicle, I paid cash, but before I paid cash, I put that money into my policy first. So, and then borrowed against my policy. That way that my $28,000 is earning that 4% tax-free compound growth for the rest of my life. I'm not interrupting that. And I don't have that lost opportunity cost. That's why, again, another part of the infinite banking concept, becoming your own bank, is financing your large capital purchases to eliminate some of that lost opportunity cost. When you look at the numbers here, over 40, 50 years, $28,000, if I had just paid cash, didn't put it into my policy first to get that uninterrupted compound growth, it would have cost me over $134,000 over the course of 40 years for this vehicle purchase. But because I put it in my policy first, I eliminated that. And the only cost to do that is the little bit of simple interest that I'm paying. Right? You do that with multiple large capital purchases, guys, that puts a significant amount of wealth back into our personal finances. All right. So that's another aspect of the infinite banking concept here. But watch this. So I took my $28,000, 5-year loan term, pretty standard for vehicles. And instead of doing the 5.5%, which is what my policy loan rate is, I put it at 8%. This is what we're paying on this particular loan. Now, watch this, guys. Here's the numbers. Here's the end result. $34,064 is what we would pay total for that loan with interest. Okay. Now, when we head over to our compound interest calculator, I'm going to plug the same numbers in, except I'm going to cut the interest rate that we earn in half to 4% just to prove the point here. $28,000 over 5 years at an interest rate of 4%. It's about what my policy earns over the lifetime of the policy. And when I calculate that, here's the number, $34,066. So at the end of 5 years, my policy is actually ahead of what I paid in interest, even though my interest rate on my policy loan was 8%, and what I'm earning in my policy is 4%. That's the difference between compounding interest and simple interest. Compound interest applied to a higher and higher balance. Simple interest being applied to a lower and lower balance. So don't get hung up on the interest rate. What type of interest rate are we talking about? How is that interest rate being utilized in this particular scenario? Are we paying simple interest and earning compound interest, or vice versa? Obviously, we want to earn compound growth, not pay it. I do want to clarify too that your policy loan can compound against you if you don't manage it. But usually, I mean, if you're setting these policies up, you're going to be using it to build wealth. You're pretty good with managing capital and managing your money. So you're going to manage your policy loan. It's not usually an issue, but always want to clarify that. But but this is the difference between simple and compound interest. So don't get hung up on the interest rate. Oh, like I'm paying 5.5, but I'm only earning 4 in my policy. What kind of interest rate are we talking about here, guys? Right? That makes a very, very big difference in the equation. Not to mention now I'm borrowing against my policy and I'm making money with my policy. I'm using that cash value to go out, build wealth by doing real estate. Like my preference, my preferred way of investing in real estate is through private money. That's just how I want to do it. And because it's just a more passive approach for me, I can continue focusing on building my businesses, etc. Right. And I'm literally becoming the bank. I'm doing the same thing, very similar that the banks do, where I'm utilizing leverage here. I'm leveraging the life insurance company's money, paying 5.5% on that. I'm lending it out at 12. What's wrong with that? What's bad? And all the while, my money is getting that uninterrupted tax-free compound growth. I have the living benefits, the death benefits, like the death benefit in case something were to happen to me. Like, I don't see how you can go wrong with it. Like, it's a really, really powerful strategy when you implement it correctly, when you set up the policy correctly in the most efficient way possible, and then you take advantage of wealth building opportunities like you normally would, right? And this is how it accelerates the wealth building process. So I hope this helps, guys. Hope it clarifies the concept of positive arbitrage. Like, we're not trying to earn positive arbitrage in our policies. Like with the policy itself, that's not why we set these up. If you do that, you're going to be pretty disappointed 9 times out of 10, I believe, because especially if you're doing whole life, like it's just not, it doesn't happen very frequently, but we don't need it to happen because of the numbers that I just showed you. Like, that's not why we do this. All right. So just be careful out there. Make sure you're doing your research. Make sure you run the numbers on these things and ask these types of questions. Right. Like, and also ask yourself, like, what are you trying to accomplish when you're setting these types of things up? Right. So hope that helps, guys. Hope you're crushing it. And I'll talk to you in the next one to your success. Matty Ice is out.